There is a number the bank knows about you before you walk through the door. Not your name, not your face, not your history with them specifically. A number that was calculated by 3 private companies you never hired, never spoke to, and never gave permission to evaluate you. A number that determines, before any conversation begins, which version of the bank you are about to experience. The teller smiles the same way at everyone, the lobby looks the same, the logo on the wall is the same, but the smile is the last thing that is equal. Everything after it, the products available to you, the rates you are offered, the fees you will pay, the speed of your approvals, the quality of your advice, and the degree to which any human being inside that institution will personally invest in your financial future, all of it flows from that number. And the number flows from your balance. This is how banks treat you at every level of wealth, not the version they advertise, the version that is actually happening. Level 1. Negative balance. Your account is negative, not by much maybe, $12, $37. The specific amount is almost irrelevant because the mechanism that responds to it does not scale with the severity, it simply activates. Here's what activates. The overdraft fee. $34.50 at the national average across major U.S. banks as of the most recent federal survey. Some institutions charge $35, some charge $36. Chase, Bank of America, and Wells Fargo have faced regulatory pressure and modified their structures in recent years, but the fee economy around low balances remains largely intact at mid-tier and community banks. The fee posts within hours, sometimes within minutes if the transaction that triggered it was processed overnight. If 3 small transactions clear while your account is negative, a $4 coffee, a $7 streaming service charge, a $2.99 app subscription, you now owe $103.50 on $13.99 in actual spending. The bank collected 7 times the value of the transactions that triggered the fees. There is a product called overdraft protection. The bank will offer it to you. What it means in practice is that instead of declining your transaction, the bank covers it and charges you $35 for the service of not embarrassing you at the register. Some banks have moved to linking your checking account to a savings account for overdraft coverage. The transfer fee for this service is typically $12. You are paying $12 to access your own money. The alternative product is an overdraft line of credit. This is a small revolving credit line attached to your checking account, typically $500 to $1,000, that covers overdrafts and charges interest instead of a flat fee. The interest rate on overdraft lines of credit at major banks runs between 18 and 21% APR. This is better than the flat fee model if your overdraft persists for more than a day or two. Almost no one at this level knows to ask for it. Almost no one at this level is offered it without asking. Your ChexSystems report is active. ChexSystems is a consumer reporting agency, not a credit bureau, a separate system entirely that tracks banking behavior, including overdrafts, unpaid fees, and account closures. If your account is closed by the bank due to negative balance, that closure appears on your ChexSystems report and remains there for 5 years. A negative ChexSystems report makes it difficult or impossible to open a new checking account at most major banks. This is how people become unbanked, not through a dramatic decision, but through a cascade. An overdraft leads to a fee, the fee isn't paid, the account is closed, the ChexSystems report is flagged, the next bank declines the application. The unbanked then rely on check cashing services that charge 1% to 3% of the check value to cash a paycheck. On a $1,400 paycheck, that is $14 to $42 per pay period, $364 to $1,092 annually, paid to access money you already earned. You are not a customer at this level. You are a fee-generating account in a segment the bank internally classifies as high maintenance and low value. The decisions about your account are made by algorithms. No human being at the institution has reviewed your specific situation. The system knows your balance is negative. Everything else follows from that. Level 2. Low balance. You are no longer negative. You have pulled it back. The account shows $340, sometimes $600 before rent clears it down again. the monthly maintenance fee activates. At Bank of America, the core checking monthly fee is $12. At Chase, total checking runs $12. At Wells Fargo, everyday checking charges $10. These fees are waived if you maintain a minimum daily balance, typically $1,500 at major banks, or receive a qualifying direct deposit above a threshold. You do not meet the threshold, so the fee posts automatically on the same date every month. You are paying between $120 and $144 annually for the privilege of keeping your money in an account that holds your money. Your savings account earns 0.01% APY. At the national average savings rate for major banks as tracked by the FDIC, your $340 earns approximately $0.03 per year. Meanwhile, the bank lends your deposits as part of their fractional reserve operations at rates between 7 and 24%, depending on the product. Personal loans, credit cards, auto financing. The spread between what they pay you and what they earn is how banking profitability fundamentally works. At your balance level, you are providing the bank with capital at essentially zero cost. You apply for a credit card. If approved, you receive a secured card. A secured card requires a deposit, typically $200 to $500, that becomes your credit limit. You are depositing money with the bank so they can lend it back to you. The interest rate on secured cards at major banks averages 24 to 26% APR. The annual fee runs $25 to $35. You are paying an annual fee and potential interest charges to borrow your own money at a 25% premium. The secured card is not a punishment, it is the entry point into the credit system for people with no credit history. Used correctly, small purchases, paid in full monthly, it builds the FICO score that unlocks better products. But the cost of building credit is borne entirely by the person who needs it most. Your FICO score at this level is likely in the 580 to 650 range, the fair category. Fair credit means you exist in a gap between subprime and standard. Subprime lenders will offer you products with predatory rates. Standard lenders will decline you. The fair category is where people stay for years without knowing exactly why or what to do about it. The bank's internal risk model has categorized your account, not by name, by behavior pattern, low average daily balance, irregular deposit timing, fee sensitivity. This pattern places you in a segment where the bank's strategy is cost minimization, providing the minimum required service at the minimum required cost because the revenue potential of your account does not justify investment. You are serviced, you are not valued. Level 3. Stable direct deposit. Something changes. The direct deposit starts. $2,800 every 2 weeks, hitting the account with the reliability of a clock. The bank's system notices this within 60 days. Not a person, the algorithm that monitors account behavior and updates customer segments. The direct deposit does two things immediately. First, it likely qualifies you for a fee waiver on the monthly maintenance charge. At most major banks, a qualifying direct deposit of $500 or more eliminates the monthly fee. You stop paying $120 a year for holding your own money. Second, it moves you into a different behavioral segment. The algorithm now sees a predictable income stream, which is the foundational signal for creditworthiness. Within 90 days of establishing regular direct deposit, many banks will begin to present you with pre-qualification offers for actual unsecured credit cards. The unsecured card offer arrives. The limit is $1,500, possibly $2,500. The APR is 22 to 26%, which is still high because your credit history is short and the bank is still pricing risk. But the door is open. The secured card required your own money as collateral. This card does not. You apply for a personal loan, $4,000 for a car repair. The approval takes 48 hours through the online portal, same day if you visit the branch. The rate is 11.99% to 14.99% APR, which is real money over a 36-month term, but functions as intended. What you are experiencing for the first time is the banking system working the way it is supposed to in the description. You needed capital, you applied, you were approved, the money arrived. This is not a small thing. This is the moment the system becomes a tool instead of an obstacle. Your bank account now has a feature turned on that was technically available before, but irrelevant given your balance. Overdraft grace periods. Some banks offer a 1-day grace period to bring your account current before the overdraft fee posts. With a stable direct deposit pattern established, you are more likely to qualify
qualify for these overdraft accommodations when they are offered. The bank has assessed that your overdrafts, if they occur, are temporary because the direct deposit arrives reliably. You are a recognized customer now. The mobile app shows you offers. The branch experience is functionally identical to before, same tellers, same waiting times, but the products available to you inside the app have expanded. You are visible to the bank as a revenue opportunity, and they are beginning to position products accordingly.
Level 4. Growing savings. You have been consistent for 3 years. The checking account maintains a $4,000 average daily balance. The savings account holds $22,000. The credit card, you have 2 now, gets paid in full every month. You have never missed a payment. Your FICO score is now between 720 and 750. This is the good tier. The good tier is where the banking relationship begins to shift in a measurable way. The first thing that changes is the credit limit. You do not ask for an increase. The bank runs periodic account reviews, soft inquiries that do not affect your credit score, and increases your limit automatically based on your payment behavior and income data. The card that started at $2,500 is now at $11,000. The bank is extending you more rope because your history shows you don't use it. The second change is the loan rate. You need to finance a car. The rate the bank offers is 6.4% APR compared to the 14.99% you were quoted 3 years ago at level 3. The difference over a 48-month, $25,000 loan is approximately $2,200 in total interest. You kept your money by having more of it. This is the compounding effect of creditworthiness. Better rates reduce your cost of borrowing, which preserves capital, which builds the balance that earns better rates next cycle. The savings account rate changes too, slightly. You qualify now for a tiered savings rate. The standard savings account at major banks pays 0.01% APY. The preferred or relationship savings tier, which activates at balance thresholds typically between $10,000 and $25,000, pays between 0.04% and 0.06% APY at traditional banks, or up to 4.5 to 5.25% at high-yield online savings accounts. If your bank has not told you about high-yield savings accounts, they have not told you because moving your savings to a high-yield account reduces the bank's access to your deposits as cheap capital. The bank is beginning to compete mildly for your future business. If you walk into a branch and mention you are considering moving your accounts, a manager will appear. An offer will be made. This did not happen at level 2. It is happening now because your account generates meaningful fee revenue from your card spend, interest revenue from your loan, and deposit capital from your savings balance. You have leverage you have not yet learned to use. Level 5, high savings and assets. Your combined deposits across checking, savings, and a money market account exceed $150,000. The money market account is new. A money market account is a deposit product, FDIC insured like a checking or savings account, that offers higher interest rates than standard savings in exchange for limited monthly transactions and a higher minimum balance requirement. At major banks, money market rates at the $100,000 threshold run between 0.5% and 1.5% APY. At online banks and credit unions, 4.5 to 5.25% is achievable. The difference on $150,000 is $6,750 annually at 4.5% versus $750 at 0.5%. The bank's branch manager will not proactively explain this to you. The phone line is different now. You have reached the asset threshold for priority banking. At Bank of America, this tier is called Preferred Rewards. At Chase, it is Sapphire Banking. At Citibank, it is Citi Priority. The names vary. The mechanics are similar. Customers above certain asset thresholds receive dedicated phone lines with shorter hold times, fee waivers on a broader range of services, and access to relationship bankers rather than call center representatives. The relationship banker is a specific role, not a teller, not a general customer service representative, a licensed banker assigned to manage accounts at your asset level. They have authority to waive fees without supervisor approval, override standard processing timelines on certain transactions, and approve modifications to account terms within their discretion parameters. When something goes wrong, a fraudulent charge, a wire transfer delayed, a check placed on extended hold, the resolution moves faster because the person handling it has actual tools. The hold time is shorter. The decision takes minutes instead of days. Certificates of deposit become relevant at this level. A CD is a time deposit instrument. You lock a fixed amount for a fixed term and receive a guaranteed rate. Current CD rates at the 12-month term range from 4.75% to 5.25% at competitive institutions. On $50,000, that's $23,750 to $26,250 in guaranteed annual return with no market risk. CD laddering, staggering maturity dates across multiple CDs, allows you to maintain liquidity while capturing higher rates. Almost no bank teller will explain CD laddering to you unprompted. It is not a complicated concept. It is simply not in their interest to optimize your return on deposits. You are a preferred client. Your name is in a system that flags your account for elevated service. The institution has assessed that retaining you is worth active effort. This is a different category of relationship than everything that came before it. Level 6. High net worth. The definition varies by institution, but generally begins at $500,000 in investable assets held within the bank's ecosystem. Wealth management is offered, not a brochure, a phone call from someone with a title, a private client advisor, or a wealth management associate. The distinction matters because this person is licensed, Series 65 or Series 66 in most states, meaning they are qualified to provide investment advice, not just banking services. The conversation changes texture. You are no longer being presented with products. You are being consulted about goals. The advisor asks about your time horizon, your risk tolerance, your tax situation, and your estate planning intentions. This is not altruism. A complete financial picture allows the bank to identify how many of its product lines apply to your situation and position itself as the single relationship managing your entire financial life. Banking, investments, insurance, trust services, and estate planning. The revenue from a fully captured high net worth client is substantially higher than the revenue from a client who only uses the bank's deposit products. The investment products available to you change. Below this level, the bank's investment offerings are essentially retail mutual funds and ETFs, accessible through a self-directed brokerage account. At this level, separately managed accounts become available. An SMA is a portfolio of individual securities managed specifically for you, not a fund you share with thousands of other investors, but a portfolio constructed to your specific tax situation, allowing for tax loss harvesting strategies that fund ownership does not permit. The mortgage process changes structurally. Loan-to-value ratios are more favorable. Jumbo loan rates, mortgages above the conforming loan limit of $766,550 in most U.S. markets as of the current year, are actually lower for clients with significant deposit and investment relationships at the same institution. The rate discount is typically 0.125% to 0.375%, small in percentage terms, meaningful in dollar terms over a 30-year mortgage. Wire transfers process differently. A $200,000 wire that would trigger a mandatory 24-hour hold and a compliance review call for a standard customer is processed same day for a high net worth client because the relationship manager pre-clears it through the compliance team on your behalf. The rules are the same. The friction of applying them is not. The waiting period between approval and funding on a personal line of credit is shorter, not because the rules are different, because the people processing it have been told whose account this is. You do not wait. Waiting is for people the institution has not yet decided to keep. Level 7, very high net worth. Above $5 million in assets, the bank's behavior changes in ways that are not published anywhere. The rate sheet does not exist for you. When you need a mortgage, the rate is a conversation between your private banker and the bank's pricing desk, not a published rate plus or minus adjustments, but a negotiated number based on the totality of your relationship value. On a $3 million mortgage, a rate 0.5% below the standard offering saves $15,000 annually. Over 30 years, that's $450,000, delivered quietly, without announcement, as a natural feature of doing business at this level. Your private banker assigned to your account manages fewer than 30 relationships. This is their entire professional world. They know your accountant, they know your estate attorney, they coordinate across those relationships without being asked, because coordination is part of their defined role at this asset level. Access to alternative investments opens. Hedge funds, private equity funds, and real estate investment vehicles that require accredited investor status, net worth above $1 million excluding primary residence, or income above $200,000 annually, or qualified purchaser status at the $5 million threshold, become available. These are not offered through retail investment menu. They exist in a separate product tier that requires a relationship conversation to access. The bank's compliance team works differently around your account. This requires honesty about what it means. Banks do not break regulations for wealthy clients. What they do is deploy their compliance and legal resources to find the maximum legal flexibility available for clients whose relationships justify the investment. A transaction that triggers an automatic hold for a standard customer is reviewed by a human compliance officer for you, quickly because your private banker escalated it, and released when it clears review rather than sitting in a queue. The waiting period between approval and funding on a personal line of credit is shorter, not because the rules are different, because the people processing it have been told whose account this is. You do not wait. Waiting is for people the institution has not yet decided to keep. Level 8. Ultra high net worth. Private banking is a different product from wealth management in the same way a chartered flight is a different product from first class. Your private banker at this level holds the title of managing director or senior private banker at a firm like J.P. Morgan Private Bank, Goldman Sachs Wealth Management, or Citi Private Bank. These are not retail bank divisions. They are separate business units with separate staff, separate product menus, separate physical spaces, and separate operating cultures. The minimum relationship threshold at J.P. Morgan Private Bank is $10 million. At Goldman Sachs Wealth Management, it is $25 million. These minimums are not always enforced rigidly. A client with $8 million in significant future wealth potential may be accepted, but they signal the category. The financial products available are structurally different. Custom lending arrangements, loans structured against a portfolio of assets rather than a specific piece of collateral, often called securities-backed lending, or pledged asset lines, allow you to access liquidity without selling investments, preserving unrealized gains and deferring tax events. The interest rate on a pledged asset line runs 0.5 to 1.5% above SOFR, the Secured Overnight Financing Rate, the successor to LIBOR, which at current rates means borrowing at approximately 5.8% to 6.8%, while your invested assets continue to compound. The tax deferral value alone can exceed the borrowing cost in a high-gain year. Foreign exchange services are different. A standard wire transfer in a foreign currency at a retail bank costs $25 to $45 in wire fees, plus a currency conversion spread of 1% to 3%. A private banking client converting $2 million in foreign currency pays institutional FX rates, spreads of 0.05% to 0.1%, and no wire fee. On $2 million, that is a difference of $19,000 to $58,000 in a single transaction. Your private banker attends your family office meetings. They know your children's names because your succession planning is part of your account management responsibilities. The relationship is not personal in the way friendships are personal. It is personal in the way a physician who has followed a patient for 20 years is personal. Professional, deep, consequential. The bank's orientation towards your account is complete. Every touch point, lending, investing, currency, estate, insurance, is managed through a single coordinated relationship designed to capture as much of your financial life as possible while delivering service at a standard that makes moving to another institution genuinely costly. You are not a customer at this level. You are the reason the floor exists. The bank did not change. You changed. Your balance changed. Your credit score changed. Your deposit total changed. And the bank's system, which is not personal, which is not cruel, which is simply calibrated to extract maximum value from every relationship tier, responded to each change with mathematical precision. The teller's smile is the same at every level. Everything behind it is not. The overdraft fee and the pledged asset line exist inside the same institution. The ChexSystems flag and the negotiated mortgage exist in the same building. The secured card with 25% interest and the separately managed account with individual tax loss harvesting are products of the same company, offered to different people at different prices based on one variable: how much of the bank's money you already have. This is not a scandal, it is a system. Systems do not have intentions, they have incentives. And the incentive of a bank is to allocate its most expensive resource, human attention, relationship investment, rate flexibility, towards the relationships that generate the most revenue. Understanding the system does not change the system, but it changes what you do next. The distance between level 2 and level 5 is not luck. It is not a different zip code or a different family. It is accumulated decisions about where money goes when it arrives and how long it stays before it leaves. The bank is already watching your account. The question is what it sees.